Hey there! Welcome. In this video, we will be digging deep into terminal federal funds rate. What is the terminal federal funds rate? The terminal federal funds rate is the ultimate interest rate target that the Federal Reserve, the Fed, aims to achieve at the conclusion of a monetary policy cycle. This rate is often considered to be the neutral rate, at which the economy is neither stimulated nor restricted. Think of it as the finishing line for the Fed's rate-hiking journey. It's the point where they believe they've tightened monetary policy enough to curb inflation and stabilize the economy. Now, why is it important? The terminal federal funds rate plays a crucial role in shaping economic conditions and influencing various financial markets. Here's why. Inflation control. The primary goal of the Fed is to maintain price stability. By raising interest rates, the Fed aims to cool down the economy, reduce demand, and ultimately bring inflation back to its target level. The terminal rate signifies the point where the Fed believes it has achieved this goal. Economic growth. While controlling inflation is paramount, the Fed also considers economic growth. The terminal rate should strike a balance between taming inflation and avoiding a recession. A rate that's too high could stifle economic activity, while a rate that's too low could reignite inflationary pressures. Financial markets. The terminal rate influences interest rates across the economy. When the Fed raises rates, it affects borrowing costs for consumers and businesses, impacting spending and investment decisions. The terminal rate sets the stage for these longer-term interest rate trends. Currency exchange rates. Changes in the federal funds rate can affect the value of the US dollar relative to other currencies. A higher terminal rate can make the dollar more attractive, potentially leading to appreciation. Investment decisions. Investors closely watch the terminal rate to adjust their portfolios. Higher rates can make bonds less attractive, potentially shifting investment flows toward other asset classes. The factors influencing the terminal rate. Several factors influence the Fed's assessment of the appropriate terminal rate. Inflation. This is the most significant factor. Higher inflation generally leads to higher terminal rates. Economic growth. In this case, a robust economy may require higher rates to prevent overheating, while a slowing economy might necessitate lower rates. Unemployment. Low unemployment can put upward pressure on wages and prices, potentially leading to higher terminal rates. Global economic conditions. Global factors such as economic growth in other countries and exchange rate movements can also influence the Fed's decision. Here's a graph showing the federal funds rate over time, with a horizontal line representing the terminal rate. Look closely. The terminal federal funds rate is a key economic indicator that reflects the Fed's assessment of the appropriate level of interest rates to maintain a stable and healthy economy. It influences various aspects of the economy and financial markets, making it an essential factor for investors, businesses, and policymakers to consider. Any question? You know I will always ask. Channel them to the comments. Thanks for watching. Do not forget to subscribe to our platform.